Imagine a company generating over $100 billion a year in revenue.
Right, a corporation hailed by Fortune magazine as America's most innovative company for an unprecedented 6 consecutive years.
Exactly. They boast a market capitalization of roughly $70 billion. I mean, they are the undeniable titans of the new economy.
But then imagine that underneath that gleaming corporate facade, that exact same company is surviving day to day by hedging its own terrible, catastrophic investments.
And doing it by using its own stock as the safety net.
It is a mathematical suicide loop playing out in plain sight.
You are in the room with us. Right now, you are sitting at the table looking at the exact same stack of evidence we are. We are operating under the banner of Peak to Dust, an investigation into the rise and fall of the giants of history.
And today, the giant on the slab is the Enron Corporation.
Our mission is to dissect a classic corporate tragedy of hubris, innovation, and ultimately, deception. We are going to examine how this $70 billion entity disintegrated into dust,
Resulting in a $63.4 billion bankruptcy, the largest in United States history at the time.
And to do this, we aren't dealing in rumors. We have the SEC filings right here. We have the internal powers report generated by Enron's own board.
We also have the findings of the United States Senate Permanent Subcommittee on Investigations.
Yeah, and we have the historical financial metrics that defined an era of, unchecked market exuberance.
The scale of this collapse demands intense scrutiny. We're looking at a forensic timeline of systemic failure, and you, sitting here with us, need to understand the mechanics of this illusion.
Because how do you hide massive existential debt when the smartest financial analysts in the world are looking right at your books?
Exactly. Or the premier credit rating agencies and your own auditors. How do you convince the market that a company bleeding cash from its pores is actually generating unprecedented profits?
The documents on the table in front of us answer those questions, but they require us to pull apart some extremely complex financial engineering.
We have to look at how Enron fundamentally mutated its physical assets, how it weaponized specific accounting loopholes, and how it constructed a labyrinth of shadow entities to hide the truth.
So let's start by looking at their meteoric peak. We have to go back to the genesis of this corporation to understand the trajectory.
Because the Enron that failed in 2001 was a completely different beast than the Enron born in 1985.
Right. In 1985, Enron was created from the merger of two regional traditional natural gas companies. That was Houston Natural Gas, or HNG, and the Omaha-based Inner North.
And HNG's CEO, Kenneth Lay, rapidly maneuvered to take control of this newly formed, merged entity.
Now look at the landscape of 1985. Enron was a heavy, asset-bound company. They operated a massive interstate network of physical natural gas pipelines.
They owned the steel in the ground.
Exactly. But Kenneth Lay recognized a shift in the political and economic winds. Deregulation was beginning to alter the energy sector.
And Lay wanted to pivot away from the heavily regulated, slow-moving, low-margin business of simply transporting physical natural gas from point A to point B.
So by 1990, he brought in Jeffrey Skilling, a consultant from McKinsey & Company, to head a new division called Enron Finance.
And Skilling brought with him an aggressive asset-light strategy.
That phrase, asset-light, that is the absolute critical pivot point in the Enron timeline.
It really is. Jeffrey Skilling's core philosophy, which he honed as a consultant, was that physical assets were actually a liability.
To him, the actual heavy steel in the ground, the pipelines, the power plants, the drilling equipment, they were not a source of competitive advantage.
No, they represented fixed costs, they required maintenance, they were a drain on profitability and agility.
Skilling believed the real value, the true economic rent in the modern era, was in information and market dominance.
So he pushed Enron to divest its physical assets. If you look at the numbers in their filings by the year 2000, Enron owned 5,000 fewer miles of natural gas pipeline than it did when the company was founded in 1985.
They were actively shedding the very infrastructure that birthed them. However, at that exact same time, their natural gas financial transactions represented over 20 times their actual physical pipeline capacity.
They systematically transformed from a company that delivered a physical commodity to a company that traded derivative contracts based on that commodity.
Right.
Wait, hold on. Let's unpack this for a second. Skilling essentially walks into a room of traditional hardened Texas energy executives and tells them that the pipelines, the actual tangible things generating their revenue, are a liability.
Yes.
How do you even sell that? Let's use an analogy here. Imagine a massive traditional logistics and freight company.
Okay.
They own thousands of trucks, sprawling warehouses, massive shipping containers, and the new CEO comes in and says, "We're selling all of the trucks, we're selling the warehouses."
Just liquidating the foundation?
Right. Instead of moving freight, we are going exclusively into trading the concept of shipping routes. They decide to trade forward contracts on the future price of diesel or the theoretical value of cargo space in the winter without actually owning the trucks to move the goods. It's a massive conceptual leap.
So how does a company that is fundamentally rooted in physical infrastructure convince Wall Street that shedding its physical foundation makes it exponentially more valuable?
Well, you convince Wall Street by demonstrating massive rapid liquidity and by positioning yourself as the indispensable, hyper-intelligent middleman in a newly deregulated space.
I see.
You have to remember the context of the early 1990s energy market. It was highly fragmented and inefficient.
Producers of natural gas face fluctuating prices, right?
Right. And buyers like local utilities faced unpredictable costs. When Skilling developed what was initially called the gas bank concept, Enron stepped right between the producers and the buyers.
So Enron would go to a gas producer and sign a long-term contract to buy their gas at a fixed price.
Exactly. Then they would go to a utility and sign a contract to sell them gas at a fixed price. Enron essentially became the market maker.
And because they were the counterparty to every single trade, meaning they were the buyer to every seller and the seller to every buyer, they absorbed the risk.
But critically, they also captured the spread between the buy and sell prices.
And Wall Street rewarded this model.
Hugely. Because on paper, trading derivative contracts requires significantly less capital investment than building and maintaining thousands of miles of physical pipeline across the continent.
The return on equity looks vastly superior in the trading model.
Assuming, and this is a massive assumption, that you can accurately manage the immense compounding risk of those derivative portfolios.
But Enron's ambitions quickly outgrew the natural gas market. To sustain this hypergrowth, they needed a bigger casino.
Which means if the marketplace for this level of trading didn't exist, well, Enron had to build it.
In late 1999, right at the absolute dizzying height of the dot-com boom, they launched Enron Online.
This wasn't just a website. This was the world's first global transaction system for wholesale energy.
And the volume of trades it handled, when you look at the raw data here, is staggering. By mid-2000, just months after its launch, Enron Online was executing nearly $350 billion in trades.
By 2001, it was handling $2.5 billion in trades every single day.
But the crucial detail, the mechanism that made this so profitable and so dangerous, is what you just mentioned about being the counterparty.
Right. Enron wasn't just matching buyers and sellers like an eBay for energy.
If you logged on and bought a contract, you bought it directly from Enron. If you sold directly to Enron.
Exactly. Being the counterparty to every transaction on Enron Online provided Enron with an unparalleled, almost omniscient informational advantage.
Think about it from a data perspective. Because every trade flowed through their books, they could see the entire market in real time.
They saw the demand spikes before they happened. They saw supply shortages forming.
They could track minute price movements across the continent before anyone else in the industry even realized what was happening.
But this model was a double-edged sword. It meant Enron was constantly exposed to astronomical levels of credit risk and market volatility.
Because if the market moved aggressively against them, they were on the hook for billions.
Yes. And to feed the relentless expectations of Wall Street, they couldn't just stick to natural gas and electricity. They had to aggressively expand this trading model into entirely new, untested sectors.
And expand they did. We're looking at their ventures outside of energy, and honestly, it borders on the surreal.
They moved aggressively into broadband telecommunications, launching Enron broadband services.
And the goal wasn't to lay fiber optic cables, right? It was to trade network bandwidth capacity as if it were a tradable commodity like wheat or oil.
Exactly. They also entered the global water market, purchasing Wessex Water in the United Kingdom for over $2 billion to form a subsidiary called Azurix.
They began trading forward contracts for paper, steel, coal.
They even began trading weather derivatives.
Weather derivatives, essentially allowing companies to hedge against the financial impact of a mild winter or a cool summer.
They were attempting to financialize entirely new sectors of the global economy, literally turning physical reality into tradable paper.
It was an attempt to turn the entire world into a derivative.
And the financial metrics they reported to the public during this expansion phase were breathtaking. If you pull the SEC filings from our stack here, Let's trace the exact reported revenue numbers. Okay, looking at 1996, Enron reported revenues of $13.3 billion.
Right. By 1999, that number had surged to $40.11 billion.
And then in the year 2000, Enron reported an absolutely staggering $100.8 billion in revenue,
That represents a 65% annual growth rate.
a 65% growth rate in the energy sector. We need to pause on that number for a second.
It's unheard of.
The energy industry traditionally is comprised of massive, slow-moving utilities accustomed to a respectable, steady 2 to 3% annual growth.
Because they are bound by the physics of power generation and the limits of consumer demand.
Enron was reporting numbers that defied the fundamental physics of their own industry. How did the market react to these impossible numbers?
The market swallowed it whole. Those reported revenues fueled a massive, speculative surge in their valuation. By August of 2000, Enron's stock price hit its all-time peak at $90.75 per share.
That gave the company a market capitalization of roughly $70 billion.
Wall Street was valuing Enron at an astounding 70 times its earnings, a 70x price-to-earnings ratio.
To understand how they achieved this suspension of disbelief, you have to factor in the psychological environment of the era.
The late 1990s dot-com boom.
Exactly. It had systematically conditioned investors, analysts, and the financial press to accept hypergrowth at face value.
And to completely ignore traditional valuation metrics like cash flow and tangible assets.
Enron brilliantly capitalized on this psychology. They positioned themselves not as a stodgy Texas pipeline utility, but as a new economy technology company.
They aggressively leveraged the launch of Enron Online to claim they were fundamentally an internet company that just happened to trade energy.
This narrative was incredibly effective. It's why Fortune magazine named them America's most innovative company for 6 consecutive years.
They were selling a story of frictionless, infinite growth.
But innovation and market dominance of this magnitude do not happen in a vacuum.
No, and they certainly don't happen within the confines of strict, traditional regulatory oversight.
Enron realized early on that to execute this asset-light, hyper-financialized strategy, they needed to rewrite the laws governing their industry.
They spent millions building an unprecedented lobbying machine to systematically deregulate the markets they wanted to dominate.
According to the evidence in the Senate subcommittee findings, Enron spent over $5 million on federal lobbyists just from 1997 onward.
And that doesn't even count the local state lobbying or the strategic political donations.
Their legislative strategy was just as aggressive and sophisticated as their trading strategy. The legislative and regulatory victories they secured were the absolute bedrock of their rapid expansion.
You can trace this systematic dismantling of regulation back to the 1992 Energy Policy Act.
Right, this act amended the Public Utility Holding Company Act, effectively opening up electricity transmission grids to outside competitors for the first time.
Enron was a primary driving force behind that legislation.
Then you look at the Federal Energy Regulatory Commission, or FERC. In 1996, FERC issued Order 888, which unbundled power generation from transmission services.
And this was followed by FERC Order 637 in the year 2000, which further deregulated natural gas distribution.
Enron's lobbyists aggressively pushed for these orders, which essentially fragmented the old utility monopolies and created the exact volatile, tradable markets Enron intended to exploit.
And it wasn't just about broadly opening markets for competition. It was about securing highly specific, targeted exemptions for their own operations.
We have the documents here. In 1993, the SEC granted Enron an exemption from the Public Utility Holding Company Act, or PUHCA.
Which allowed them to invest capital in riskier non-utility businesses without facing the strict oversight designed for power companies.
Right. Then in 1997, they secured another massive exemption from the SEC, this time regarding the Investment Company Act of 1940.
This specific exemption critically allowed Enron to keep debt from their sprawling foreign infrastructure projects entirely off their consolidated books.
And perhaps most significantly, they lobbied relentlessly for the Commodity Futures Modernization Act of 2000.
The Commodity Futures Modernization Act is a crucial piece of this puzzle.
It really is. This legislation included a specific provision that shielded electronic energy derivatives trading from oversight by the Commodity Futures Trading Commission, the CFTC.
This created what became infamously known as the Enron loophole.
Yes. It allowed Enron to operate Enron Online and trade billions of dollars in complex energy derivatives in the dark.
Without the transparency, reporting, and capital reserve requirements demanded of traditional regulated financial exchanges like the Chicago Mercantile Exchange.
Precisely.
Look at the sequence of exemptions. We have SEC exemptions allowing them to hide foreign debt, FERC orders restructuring the grid for their benefit, and the CFMA shielding their core trading platform from federal oversight.
It's incredibly systematic.
We have to ask the critical question here. At what point does a corporation stop being a market participant and become a shadow regulator?
Well, the documentation strongly suggests Enron crossed that line when their entire business model became structurally dependent on the regulatory blind spots they themselves engineered.
They were not just advocating for free markets, as they claimed in their press releases.
No, they were systematically dismantling the oversight mechanisms that would require them to report their true risks accurately.
They engineered a bespoke regulatory environment where they could take on massive, unprecedented leverage and risk without triggering a single alarm at the federal level.
So Enron has essentially lobbied away the referees. They are operating in a dark room of their own design.
But the problem with a dark room is that while no one can see you cheating, no one can see you bleeding either.
Exactly. And underneath this massive reported revenue growth of $100 billion, Enron's cash flow was deteriorating.
They were hemorrhaging actual cash.
To hide that grim reality and maintain the illusion of the soaring stock price, they had to turn to the accounting department.
And this brings us to the exact mechanism that doomed the company. The very tools that allowed Enron to grow unhindered were the same tools they weaponized to fabricate reality.
The primary weapon in their arsenal was mark-to-market accounting.
In June 1991, Jeffrey Skilling formally requested SEC approval to use mark-to-market, or MTM, accounting for Enron's natural gas trading business.
And the SEC officially granted that approval in January 1992.
We need to be clear here. Mark-to-market accounting is a legitimate, standard financial practice in certain contexts.
Yes, it is heavily utilized by Wall Street broker-dealers for highly liquid securities.
If you hold 1 million shares of IBM stock, mark-to-market simply means you record the value of those shares at today's closing market price.
But Enron applied this concept to incredibly complex, illiquid, long-term energy and service contracts.
Here is how it fundamentally warped their reality. Under traditional historical cost accounting, when a company signs a 20-year service contract, they are required to recognize the revenue and profit gradually over the life of that contract.
Only as the services are actually delivered and the physical cash is collected from the client.
Right. But mark-to-market accounting allowed Enron to do something entirely different.
It allowed them to record the estimated present value of all projected future net cash flows from that contract the very moment the ink dried on the signature page.
You are legally booking projected profits for the next 10 or 20 years on day one before you have delivered a single ounce of natural gas or collected a single dollar from the customer.
The specific example that illustrates the sheer audacity of this practice, sitting right here in the SEC filings, is the July 2000 partnership between Enron Broadband Services and Blockbuster.
They announced a 20-year deal to stream movies on demand over Enron's supposedly state-of-the-art fiber optic network.
Now, based on their own highly optimistic internal projections of how the untested video-on-demand market would grow over the next 2 decades, Enron applied mark-to-market accounting.
They booked $110 million in estimated future profits onto their income statement almost immediately.
But let's look at the reality of that deal. The streaming technology failed to work at scale.
The major Hollywood studios absolutely refused to grant Blockbuster the necessary digital rights.
The projected market evaporated before it even existed, and the deal collapsed in a matter of months.
Blockbuster completely walked away from the partnership.
Yet Enron still had that $110 million in profit recorded on their books as if it were cold, hard cash already sitting in the bank.
The Blockbuster deal perfectly exposes the fatal flaw of what accountants refer to as level 3 asset valuation.
Yes. When you are dealing with bespoke, long-term energy contracts or unprecedented speculative broadband deals, there is no active liquid market to determine a fair, objective price.
There is no daily ticker tape telling you what a 20-year streaming contract with Blockbuster is worth today.
Therefore, the accounting rules dictate that the valuation relies entirely on internal management estimates.
Enron's executives were granted the autonomy to subjectively manipulate the complex inputs of their own financial models.
They could alter their assumptions about future interest rates, future commodity prices, consumer adoption rates, and default risks.
By tweaking these hypothetical inputs in a spreadsheet, they could literally engineer the model to spit out whatever profit number they needed to hit their quarterly earnings targets for Wall Street analysts.
It is the equivalent of a marathon runner showing up at the starting line, signing the registration form, and immediately demanding the gold medal.
And the prize money and the lucrative shoe sponsorship deals, regardless of whether they ever take a single step or actually finish the race.
The reported profit is entirely divorced from the physical performance.
That is a perfect analogy. And that precise separation between reported theoretical profit and actual physical cash flow is what triggers a fatal liquidity crisis.
Because mark-to-market accounting allowed Enron to record hundreds of millions of dollars in future cash that didn't actually exist in the present. They looked wildly profitable on their income statement.
But if you looked at their cash flow statement, they were bleeding out.
They were spending billions of real dollars on heavy international infrastructure projects, massive power plants in Dabhol, India, sprawling water systems in the UK that were failing miserably to generate actual cash returns.
When those international deals went bad and the real-world market moved aggressively against their rosy internal projections, the rules of mark-to-market dictated that Enron must write down the value of those contracts and report massive, immediate losses.
But reporting those true losses would destroy their pristine earnings record,
Which would collapse their stock price.
which would trigger downgrades in their credit rating. And their high stock price and investment-grade credit rating were the only things keeping the company alive and allowing them to borrow more money.
Which leads us directly to the cover-up. When the bad investments threatened to drag down the stock price, Enron had to find a place to hide them.
We turn to the dump sites, the special purpose entities, or SPEs.
Enron utilized thousands of these complex, off-the-books shell companies. Now, special purpose entities are not inherently illegal.
No, but to understand the sheer scale of the fraud, we must look at the specific accounting rule they systematically exploited.
Under the Financial Accounting Standards Board guidelines of the time, a parent company did not have to consolidate an SPE's debts onto its own public balance sheet if two strict conditions were met.
First, an independent third party had to hold a minimum of a mere 3% equity stake in the entity, just 3%.
And second, that independent third party had to possess actual substantive control of the SPE's decision-making.
That 3% rule was originally intended for legitimate corporate risk sharing, like a consortium of airlines creating an entity for aircraft leasing.
But Enron weaponized this standard.
They abused this rule by capitalizing these special purpose entities primarily with Enron's own stock or debt guarantees.
And critically, to fulfill the independent requirement, they installed their own senior executives to run them.
By doing this, they violated both the spirit and the letter of the independence requirement.
But it allowed Enron to execute a brilliant, toxic maneuver.
They could essentially sell their underperforming assets, their massive debts, and their looming mark-to-market losses to these SPEs.
Because the SPEs were technically legally classified as independent entities, Enron could record these transfers as legitimate sales.
They booked immediate revenue from the sale while simultaneously sweeping the toxic debt and the assets' true losses off their consolidated balance sheet.
I want to make this tangible for you. Imagine a teenager who has secretly maxed out 5 different credit cards. They know if their parents see the statements, they're grounded forever. So the teenager goes to their neighbor and says, "I'll give you 3% of my allowance if you let me put all my credit card debt in your name."
We'll pretend the debt is yours, so when my parents look at my bank account, I look totally responsible.
Exactly. The neighbor agrees, the debt is hidden, and the teenager's parents continue to think their kid is a financial genius.
That is exactly what Enron was doing on a multi-billion-dollar scale.
Let's examine the specific entities and the exact figures detailed in the Powers Report. We have an entity called Chuco, which was secretly managed by an Enron finance executive named Michael Copper.
Then we have the infamous LJM partnerships, specifically LJM1 and LJM2.
These weren't run by mid-level managers. These were run directly by Enron's own sitting chief financial officer, Andrew Fastow.
The internal documents point to an astonishing October 1999 Board of Directors meeting. At this meeting, the Enron board explicitly voted to waive the company's own formal code of ethics.
They did this specifically to allow Fasto to serve as the general partner of LJM, despite the blatant, massive conflict of interest of the CFO negotiating financial deals between Enron and an entity he personally controlled and profited from.
The records show Fasto personally pocketed roughly $45 million from managing these deals.
Think about the mechanics of what the board authorized. Fasto was literally sitting on both sides of the negotiating table.
He was Enron's CFO, legally tasked with a fiduciary duty to protect the shareholders and secure the best possible terms for Enron.
Simultaneously, he was operating LJM with the explicit mandate to extract maximum profit from Enron for the benefit of LJM's investors, which included himself.
It's an impossible contradiction.
By transferring billions of dollars in toxic assets and debt to LJM and these other SPEs, Fasto created a completely false image of financial health.
Enron's public balance sheet looked miraculously clean. Their debt-to-equity ratios looked pristine.
This illusion successfully fooled the major credit rating agencies Moody's, Standard & Poor's, Fitch.
And it fooled the army of Wall Street analysts who continued to issue strong buy recommendations, driving the stock price even higher.
But looking at this evidence, this forces us to confront a massive, terrifying institutional failure. We aren't just looking at a few rogue executives in a back room.
No, we are looking at a scenario where the board of directors actively, formally waived the ethics code.
We have the external auditors, the prestigious Arthur Andersen, actively signing off on the accounting treatment of these SPEs.
We have elite outside legal counsel, Vinson and Elkins, drafting the dense legal documents to structure these entities.
If the executives, the board, the auditors, and the lawyers all actively sign off on a structure specifically designed to obscure the truth from the public, where does the line between corporate negligence and active criminal conspiracy blur?
That is the exact question that the Senate Subcommittee report and the Internal Powers report grapples with. Both reports heavily criticized that exact systemic breakdown.
The gatekeepers, the institutions designed to protect the public markets, failed entirely.
Arthur Andersen, for example, was billing Enron over $1 million a week in combined audit and consulting fees.
Their independence was deeply structurally compromised because Enron was one of their largest clients globally. They couldn't afford to say no.
The board of directors later claimed they were misled by management, that the structures were too complex.
But the documentary evidence shows they explicitly approved the structures and utterly failed to ask the basic probing questions required of their fiduciary duty.
When a board permits the sitting CFO to run an off-books entity conducting billions of dollars in opaque business with the parent company, negligence edges dangerously close to complicity.
They authorized a structure that was mathematically destined to collapse the moment Enron's stock price stopped climbing.
And that mathematical certainty materialized in the most toxic, desperate structures of all, the Raptors.
As the dot-com bubble began to burst in 2000 and Enron's investments in tech and broadband started hemorrhaging value, Fasto's schemes grew increasingly desperate.
LJM2 created 4 specific special-purpose entities known as the Raptors. Their stated purpose was to act as a hedge against massive potential losses in Enron's merchant investments.
For example, Enron had invested heavily in an internet communications company called Rhythms Net Communications.
When the tech bubble popped, the value of that stock plummeted. Enron used the Raptors to theoretically hedge against that severe drop, ensuring Enron wouldn't have to report the loss on its public income statement.
But the fatal flaw in the Raptors goes to the very heart of the Enron fraud. Let's break down how a hedge is supposed to work.
A legitimate financial hedge requires transferring risk to an independent third party that has its own capital, its own distinct balance sheet, to absorb the loss if the bet goes bad.
If I want to insure my house against a fire, I buy a policy from an insurance company that has billions in reserve. I don't write an insurance policy on my own house and put it in my own safe.
But the Raptors had no independent capital. Enron capitalized the Raptors using its own inflated stock and forward stock contracts.
They were essentially hedging Enron's highly risky merchant investments, using Enron's own shares as the ultimate safety net.
According to the data extracted from the Internal Powers report, these Raptors structures were used to successfully shield Enron's public income statement from over $1.077 billion in actual losses between mid-2000 and the third quarter of 2001.
Hedging a company's bad investments with its own stock is a suicidal financial loop. Think about the logic.
If the investments go bad, which they did, the SPE, the Raptor, has to pay Enron to cover the loss.
But the Raptor has no cash. The SPE's only way to pay Enron is by selling the Enron stock it holds.
Exactly. It creates an inescapable death spiral. As long as Enron's stock price remained artificially high, the Raptors appeared solvent on paper.
They had enough theoretical value to cover the losses.
But as the broader tech sector crashed in 2000 and 2001, and Enron's own underlying operational cash flow problems became impossible to ignore, Enron's stock price inevitably began to fall from its $90 peak.
As the stock price dropped, the value of the assets inside the Raptors plummeted simultaneously.
This meant the Raptors lost their mathematical ability to cover Enron's bad bets.
And because Enron had secretly guaranteed the debts of these SPEs to make the structures work, the billion-dollar losses that were hidden off balance sheet suddenly boomeranged back onto Enron's public books.
The entire illusion required a perpetually rising stock price. Gravity was the one thing their financial models couldn't hedge against.
That gravity finally caught up with the executive suite in the summer of 2001. We can track the timeline of the unraveling through the internal memos and public filings.
In February 2001, Jeffrey Skilling formally took over as CEO from Kenneth Lay, reaching the absolute pinnacle of the company he helped transform.
But merely 6 months later, on August 14, 2001, Skilling abruptly resigned, citing vague personal reasons. Kenneth Lay immediately resumed the CEO role.
Skilling's sudden, unceremonious departure was a massive, blaring red flag to the financial markets.
You do not abandon the ship of a $70 billion corporation you spent a decade ruthlessly building just as it hits rough waters, unless you know the hull is irreparably breached.
Internally, the panic was already setting in. Fasto and his team were frantically trying to restructure the Raptors, desperately trying to find real cash to plug the billion-dollar holes in the balance sheet.
And the hypocrisy of the executive actions during this specific window is staggering. In August 2001, just after Skilling's exit, SEC filings show that Kenneth Lay quietly sold 93,000 of his own Enron shares for roughly $2 million.
Simultaneously, while he was actively dumping his own stock into the market, Lay was sending out company-wide emails to Enron employees, assuring them the corporation was on incredibly solid footing.
He was explicitly predicting a significantly higher stock price.
He was actively encouraging the rank-and-file employees to buy and hold Enron stock in their retirement accounts, while he was secretly cashing out his own chips.
This specific period also generated one of the most critical documents in the entire investigation, a document that proved executives knew exactly what was happening, the Sharon Watkins memo.
In mid-August 2001, Sharon Watkins, an Enron vice president of corporate development who had previously worked under Fasto, sent a devastating, anonymous 6-page internal memo directly to Kenneth Lay.
Watkins had analyzed the Raptor structures and realized they were completely unbacked, relying entirely on Enron's own declining stock.
In her memo, she explicitly warned Lay of the impending accounting scandals. I want to highlight her exact phrasing. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals."
She laid out the math, showing that the Raptors owed Enron hundreds of millions of dollars they could never pay.
The chilling contrast here is profound. Look at the duality of the corporation in August 2001.
You have the internal reality, the Watkins memo detailing a billion-dollar house of cards ready to collapse at any moment, Fasto scrambling to plug holes in the Raptors, Skilling fleeing the building.
And then you have the external corporate propaganda, with Kenneth Lay feeding daily assurances to his employees, the press, and the public markets that Enron's best days were ahead.
But the internal dam could not hold. It finally broke in October 2001, spilling the fraud out into the public markets for everyone to see.
The free fall was astonishing in its velocity. We can track the collapse day by day, and you can see how quickly confidence evaporates.
On October 16, 2001, Enron shocked the market by reporting a third-quarter loss of $618 million, though some regulatory filings adjust this to $638 million.
But the loss wasn't the killing blow. More devastatingly, they casually announced a massive $1.2 billion reduction in shareholder equity.
This unprecedented reduction was directly linked to the unwinding and unraveling of Andrew Fasto's LJM and Raptor partnerships.
Wall Street analysts finally woke up and started asking how $1 billion in equity could simply vanish overnight.
The dominoes fell rapidly after that. On October 22, the Securities and Exchange Commission officially launched an inquiry into Enron's accounting practices, specifically targeting the SPEs.
And look at this detail from the criminal trials. On that very same day, October 22, officials at Arthur Andersen's Houston office urgently began shredding thousands of Enron audit documents and deleting tens of thousands of emails.
They were destroying the trail. By October 24, the capital markets completely froze Enron out. Enron was suddenly unable to roll its commercial paper.
We need to explain what that means, because it's the mechanism of death for a modern corporation. Commercial paper represents the short-term, unsecured loans a company uses to fund its day-to-day operations, paying salaries, settling daily trading accounts.
Companies constantly borrow money overnight and pay it back the next day.
When the market lost confidence in Enron's books, no one would lend the money overnight. When they couldn't roll their commercial paper over, your liquidity vanished instantly.
They had no cash to operate. On that same day, facing immense pressure, Enron finally fired Andrew Fastow.
But firing Fastow couldn't stop the bleeding. On November 8, Enron announced it would have to restate its earnings back to 1997, reducing reported net income by nearly $600 million.
They were essentially admitting to the SEC and the public that years of their financial filings, the numbers that drove the stock to $90 were pure fiction.
Later in November, a rival energy company, Dynegy, which had floated a desperate last-minute acquisition deal to save Enron, backed out entirely.
They walked away after the major credit rating agencies finally downgraded Enron's debt to junk status.
The climax arrived on December 2, 2001. With no cash, no credit, and their stock worthless, Enron officially filed for Chapter 11 bankruptcy protection.
The stock, which had traded at nearly $91 a share just 15 months prior, crashed to 26 cents.
A $70 billion valuation evaporated in a matter of weeks.
And it evaporated simply because the market lost confidence in the integrity of the numbers.
In the financial markets, trust is the only actual currency. Once the market realized the balance sheet was fabricated, the physical assets they still had, the remaining pipelines, the trading desks, the broadband networks, could not halt the death spiral.
The human cost of this collapse was catastrophic, and it was exacerbated by a brutal administrative decision. In October 2001, just as the crisis was peaking and the stock was in freefall, Enron changed its pension plan administrators.
This administrative change triggered a mandatory blackout period, locking Enron employees out of their 401k accounts for 30 days.
While the top executives had been aggressively cashing out their stock options for months, the rank-and-file employees were legally forbidden from selling their Enron stock while the price plummeted towards zero.
The bankruptcy wiped out $2 billion in pension savings and $1.2 billion in retirement funds for 20,000 Enron employees.
People lost their life savings in a matter of days.
The devastation triggered a massive, sweeping criminal aftermath. The judicial fallout fundamentally reshaped the American corporate landscape.
Arthur Andersen, one of the prestigious Big Five accounting firms with a 90-year history of auditing the world's largest companies, was indicted and convicted of obstruction of justice for shredding the Enron documents.
Although the Supreme Court later overturned that specific conviction years later on a jury instruction technicality, the indictment alone effectively destroyed the firm. Clients fled, and it cost 28,000 Andersen employees their jobs.
The executives who engineered the fraud faced the justice system. Andrew Fastow pleaded guilty to 2 counts of conspiracy and fraud, agreed to serve a 10-year prison sentence, and forfeited $24 million.
Jeffrey Skilling was convicted of multiple counts of fraud, conspiracy, and insider trading. He was sentenced to 24 years in prison and fined $45 million.
Kenneth Lay was also convicted of multiple counts of fraud and conspiracy, but he died of a massive heart attack before his sentencing could take place.
Because he died before exhausting his appeals, his conviction was vacated under the legal doctrine of abatement ab initio, effectively erasing his criminal record.
The legislative impact of Enron's collapse was equally profound. The sheer scale of the fraud directly resulted in the rapid passage of the Sarbanes-Oxley Act of 2002.
This was the most sweeping legislative response to corporate fraud since the Great Depression.
The law was intended to force corporate accountability, mandate independent auditing oversight by creating the Public Company Accounting Oversight Board.
And, crucially, hold CEOs and CFOs personally, criminally liable for the accuracy of their financial statements. They must now personally sign off on the numbers under threat of prison.
We have examined the evidence on the table. We have traced the trajectory from the physical pipeline to the derivative portfolios, through the massive lobbying efforts into the dark accounting of mark-to-market, through the dump sites of the SBEs, and down into the ashes of Chapter 11.
The Enron tragedy stands as a stark, solemn reminder that a corporate empire built on a foundation of intellectual arrogance, manipulated regulations, and fabricated ledgers can only survive for exactly as long as the market believes the illusion.
Once the illusion fractures, the descent from pick to dust is absolute and irreversible.
The mechanics of the fraud were highly complex, layered in derivative contracts and obscure accounting rules, but the underlying flaw was primal.
It was a corporate culture that systematically prioritized the appearance of success over the reality of the balance sheet, enabled by a network of gatekeepers who traded their independence for lucrative fees.
A complete systemic failure.
Which leaves us with a final, chilling question to consider as we close this file. The Sarbanes-Oxley Act was designed to prevent another Enron. It strengthened the auditing rules and forced executives to sign the filings.
Right.
But in a modern financial landscape where digital assets, complex unregulatable derivatives, and high-frequency algorithms move trillions of dollars across borders at the speed of light, are we truly protected from the next iteration of mark-to-market deception?
Or has the hubris of financial engineering simply evolved beyond the regulators once again, building new, invisible structures in the dark?
Thank you for joining us in Vaultigation. Keep digging.